What does 10K, 50K, or 100K actually generate in passive income? Dividend stocks, REITs, index funds, and I-bonds explained, with real numbers, not hype. What does 10K, 50K, or 100K actually generate in passive income per year? We break down dividend stocks, REITs, high-yield savings accounts, index funds, and I-bonds, with realistic numbers, not influencer hype. This is your complete passive income blueprint for 2024 and beyond. High-yield savings accounts, Marcus, Ally, SoFi, or similar. I-bonds, TreasuryDirect. Dividend ETFs, VYM, SCHD. REITs, VNQ, O, Realty Income. Index funds, VTI, VTSAX, FZROX. Passive income for beginners, dividend stocks explained. REITs for beginners, index fund passive income. High-yield savings account. I-bonds 2024. How to make money while you sleep. Passive income blueprint. VYM, SCHD dividend ETF. Realty income REIT. 100K passive income. Wealth blueprint. Financial freedom. Investing for passive income. The Wealth Blueprint. Background: dark charcoal black, premium feel. Center: person sleeping in a bed, but around them float glowing dollar signs and upward arrows, money literally moving while they sleep. Bold text at top: make money while you sleep, in bright white, all caps. Subtext below in gold: 10K equals $500 month passive. Bottom strip: small icons of piggy bank, house, stock chart, representing the passive income streams. Clean, premium look, consistent with a finance channel. What if your biggest financial asset wasn't your job? What if, whether you showed up to work tomorrow or not, your bank account grew anyway? That's not a fantasy. That's the mathematical outcome of building a passive income portfolio. And in this video, I'm going to show you exactly how to build one, with real numbers, not hype, and what you can realistically expect from $10,000, $50,000, and $100,000 invested. The conventional financial playbook goes like this: work hard, get paid, spend most of it, and retire at 65 and hope you have enough. The problem with that plan is that it makes you entirely dependent on your own time and labor. You stop working, the money stops coming. Get sick, the money stops. Get laid off, the money stops. Passive income breaks that dependency. True financial freedom isn't just about having money. It's about having money that works independent of your time. And you don't need to be a millionaire to start building that. You can start today with what you have. Here's your blueprint. This is the entry point. No risk, no volatility, no knowledge required. Just a better parking spot for the money you already have. A regular bank savings account pays you somewhere between 0.01 and 0.5% interest. That's essentially nothing. A high-yield savings account from an online bank, Marcus by Goldman Sachs, Ally, SoFi, or similar, is currently paying 4.5 to 5% APY. Account type: balance, annual interest earned. Traditional savings, 0.5%, $10,000, $50 per year. High-yield savings, 4.75%, $10,000, $475 per year. High-yield savings, 4.75%, $50,000, $2,375 per year. High-yield savings, 4.75%, $100,000, $4,750 per year. That's $4,750 a year, almost $400 a month, just for keeping your emergency fund and cash reserves in the right account. Zero additional work. You don't pick stocks. You don't manage a property. You just switched banks. This is not a long-term wealth strategy. It's a baseline. Do this immediately. I-bonds.
Treasury bonds issued by the U.S. government are one of the most underrated investments available to everyday Americans.
Here's why they're unique. Their interest rate is tied to inflation. When inflation is high, your I-bond rate is high. When inflation drops, your rate adjusts down. You're always keeping pace with the cost of living, guaranteed by the United States government. Recent I-bond rates peaked above 9% during the 2022 inflation surge. Current rates are lower but still competitive with high-yield savings, with the added benefit of being state and local tax-free. The limitations? You can only buy $10,000 per person per year through TreasuryDirect.gov. And there's a 1-year lockup. You can't touch it for 12 months. After that, you can redeem anytime. Who it's for? Anyone who wants a guaranteed, inflation-protected return on cash they won't need for at least a year. It's a perfect fit for a portion of your emergency fund or medium-term savings. Now we're moving into assets that can generate serious, recurring cash flow. Dividend stocks are companies that share a portion of their profits with shareholders on a regular basis, typically every quarter. You buy the stock, you hold the stock, and every 3 months, cash hits your account. No selling required. The yield, the percentage of the stock price paid back as dividends annually, varies by company and sector. Utilities, 3 to 5% average yield. Consumer staples, think Procter & Gamble, Coca-Cola, 2 to 4% yield. REITs, coming up next, 4 to 7% yield. High dividend ETFs, 3 to 5% yield. The smart play for beginners, instead of picking individual dividend stocks, use a dividend ETF, a single fund that holds dozens or hundreds of dividend-paying companies automatically. VYM, Vanguard High Dividend Yield ETF, holds 440-plus dividend stocks, 2.8 to 3.2% yield, expense ratio 0.06%. You get diversification across hundreds of companies for basically nothing. SCHD, Schwab U.S. Dividend Equity ETF, more selective, higher quality companies, 3.5 to 4% yield, one of the most popular income ETFs on the market. $50,000 in SCHD generates roughly $1,750 per year in dividends. That's $145 a month deposited automatically without you doing anything. Real estate investment trusts, or REITs, are companies that own income-producing real estate, shopping centers, apartment buildings, warehouses, hospitals, cell towers. They collect rent, and by law, they must distribute at least 90% of their taxable income to shareholders as dividends. This means REITs tend to have the highest dividend yields of any asset class available to retail investors. The NTU, Vanguard Real Estate ETF, the simplest way to own a diversified basket of REITs, holds 160-plus real estate companies. Current yield, approximately 4 to 5%. Realty Income, ticker O, nicknamed the Monthly Dividend Company because it pays dividends every month, not quarterly. Yield, approximately 5 to 6%. It has raised its dividend over 120 times since going public. For someone who wants consistent, predictable cash flow, like supplemental monthly income, REITs and specifically monthly dividend REITs are one of the most effective vehicles available. Index funds are the anchor of the Wealth Blueprint strategy. We've mentioned them in previous videos, but here's why they deserve their own spot in a passive income discussion. Most people think of index funds purely as growth assets, and they are, but they also distribute dividends. The underlying companies in the S&P 500 pay dividends, and those get passed through to you. VTI, Vanguard Total Stock Market ETF, currently yields around 1.3% in dividends annually, on top of the historical 8 to 10% growth rate.
On a large enough portfolio, that 1.3% dividend yield becomes meaningful, and the growth component is where the real long-term passive income comes from, because a larger portfolio generates more passive income every year. $100,000 in VTI today, year 1 about $1,300 in dividends. Year 10, if the portfolio has grown to $215,000, about $2,800 in dividends. Year 20, if the portfolio has grown to $466,000, about $6,000 in dividends. The dividends grow because the portfolio grows. The portfolio grows because you don't touch it. This is the long game, and it wins. Conservative passive income estimates, blended portfolio across all 5 streams. Portfolio size, annual passive income, monthly passive income. $10,000, $400 to $650, $33 to $54 per month. $25,000, $1,000 to $1,625, $83 to $135 per month. $50,000, $2,000 to $3,250, $166 to $270 per month. $100,000, $4,000 to $6,500, $333 to $542 per month. $250,000, $10,000 to $16,250, $833 to $1,354 per month. $500,000, $20,000 to $32,500, $1,666 to $2,708 per month. $100,000 invested across these passive income streams generates between $333 and $542 per month without you lifting a finger. That covers a car payment, a credit card bill, part of a rent payment. That's not retirement, but it's freedom from one bill. And as you keep building, it covers 2 bills, then 3, until one day your passive income covers everything, and your job becomes optional. This is why the channel is called The Wealth Blueprint, not because we're selling you dreams, because wealth isn't a mystery. It has a structure, a sequence, a blueprint. High-yield savings first, I-bonds for inflation protection, dividends for cash flow, REITs for income, index funds for long-term growth. Build each layer. Let them compound together. The blueprint is right here. The only question is when you start. Here's your action item from this video. Look at your current savings. If any of it is sitting in a traditional bank account earning less than 1%, move it to a high-yield savings account today. That single move could earn you hundreds of dollars more per year for 0 additional effort. Then if you haven't already, open a brokerage account, pick one of the ETFs we covered, VTI, VYM, or VNQ, and set up a recurring monthly investment, even $100 a month. Start the blueprint. Every video on this channel is one piece of the blueprint. High-yield savings, I-bonds, dividends, REITs, index funds, and next week we're going back to fundamentals, recovering the exact psychology that separates people who build wealth from people who don't. The mindset stuff nobody talks about with the behavioral data to back it up. If this video gave you value, subscribe. Every week, one clear, actionable strategy, no fluff, no filler, just the blueprint. See you next week.